Every major piece of equipment in a property, whether it's the AC on the roof or the water heater down in the basement, well, it's kind of living a double life. Seriously. One is its physical life, how long it actually works before it gives up the ghost. The other is its financial life, how long the bean counters and the tax codes say it's still worth something. Understanding both of these lives is a huge deal for your bottom line. And today, we're going to dig into why.
So picture this. It's the middle of a brutal heat wave, and your commercial air conditioner decides to just die. Ugh. It's a massive, totally unexpected expense. You're thinking, I thought that thing had a few more years left in it. But did it, really? And, maybe more importantly, how does this sudden, expensive reality mess with your whole financial plan, your budget, your tax strategy? That's the core problem we're going to unpack right now.
All right, to really get to the bottom of this, here's how we're going to break it down. First, we'll look at an asset's physical life, from an engineering point of view. Then we'll switch hats and look at its financial life from an accountant's perspective. We'll get into this thing called depreciation, see where the real world and the rulebook totally clash, and finally, take a peek at what all this means for the future.
Okay, let's get right into it. This whole problem really boils down to looking at the exact same piece of equipment through two completely different lenses. It's wild. One lens sees the nuts and bolts, the wear and tear, the physical reality. The other sees spreadsheets, complex tax codes, and your long-term financial strategy. Same asset, two totally different stories.
First up, let's talk about the physical world. This is all about the tangible, real-world stuff. How long is a machine actually designed to run? How long does it really last out in the field before it just breaks down for good? This is the world of engineering, right? And getting this number right is your first line of defense against those nasty, expensive surprises.
So engineers have a pretty specific term for this, effective useful life, or EUL for short. Now the key words here are median and operable. This isn't about the absolute maximum lifespan, that 1 in a million unit that lasts forever. Nope. It's the statistical tipping point, the age where if you installed 100 of these things, about 50 of them have probably already failed. It's the 50-50 mark.
Now check this out, because this is where it gets really interesting. These EOLs aren't set in stone. They actually change as we get more data. A recent study from DNV found that some new tech, like HVAC heat pumps, are lasting way longer than we thought, jumping from 15 to a proposed 20 years. Awesome, right? But look at the gas storage water heater. Its real-world lifespan has actually gone down from 15 to 13 years. This isn't just trivia, people. These little numbers shifting around can have a huge impact on your replacement budget.
So, how in the world do they figure this stuff out? Well, it's all about data, and it's visualized in something called a survival curve. This chart basically just plots the chances of a piece of equipment still being alive and kicking over time. You can see how that line steadily drops as the years go by. The exact moment it crosses that 50% survival line, bam, that's the EOUL. And for this water heater, it happens right on the dot at year 13.
All right, so that's the physical world, the engineering side of things. But now we have to completely switch gears and jump into the financial world. And trust me, it plays by a totally different set of rules. Over here, an asset's life isn't determined by rust or wear and tear, but by tax law and accounting principles. And that has enormous implications for your bank account.
Okay, the first thing you have to get straight is the difference between an operating expense, or OPEX, and a capital expense, or CAPEX. Think of it like this. OPEX is for just keeping things running, like patching a leaky pipe. You can deduct that whole cost right away, in the same year. But CAPEX is for making things better, a major improvement, like replacing the entire HVAC system. That's a big, long-term investment, and the tax rules for it are completely different.
And let me be clear. Getting this wrong is not a small mistake. As the experts over at Landlord Studio put it, messing this up can cause a whole world of hurt, from missing out on deductions and creating cash flow nightmares to even getting a scary letter from the IRS. Yep, the stakes are definitely high.
So if you can't deduct a huge capital expense all at once, what are you supposed to do? Well, this is where the wonderful world of depreciation comes into play. It's basically the special accounting tool that lets you gradually write off the cost of a major asset over what the IRS calls its useful life.
Let's walk through a super clear real-world example to see exactly how this works. Let's say a landlord has to replace the entire roof on a rental property. That is a classic textbook capital improvement.
And the total bill for this massive project comes out to a solid $12,000. That's a big chunk of change that you absolutely have to account for the right way.
Now here's the catch. You can't just write off that 12 grand on this year's taxes. The IRS says, nope,
You got to spread that cost out. You have to depreciate it over a period they have decided is that asset's useful life for tax purposes.
And for a structural improvement like a roof on a residential rental property, that useful life is, get this, 27.5 years. Yeah, you heard me right. That number has absolutely nothing to do with the warranty on the shingles or how long a roofer says it'll last. It is purely a number made up for financial reasons.
So here's where the rubber meets the road. The math is simple, but that timeline is painfully long. You just took a $12,000 hit to your cash flow today, but your annual tax deduction is only about $436. This is the financial reality of those big repairs. Okay, so we've seen the physical reality from the engineers, and we've seen the financial rules from the accountants. Now for the fun part. Let's put them side by side and see what happens when they collide. Because this right here is where the real headache is for property owners. Let's go back to our old friend, the gas storage water heater. Remember? The engineering study, based on tons of real-world data, tells us its physical lifespan, its EUL, is just 13 years. After 13 years, you're on borrowed time. But for years, the financial rules treated that exact same water heater as having a 15-year life. And this just perfectly illustrates the problem. At year 13, your unit is physically dead and leaking all over the floor, but on the financial books, it still has 2 more years of value left to depreciate. See the conflict? And there it is. That's the aha moment, the whole dilemma in a nutshell. This creates a really painful gap. You have to physically replace an asset and pay for it out of your own pocket years before the financial and tax systems even agree that its value has hit zero. This can absolutely wreck your cash flow planning. And this isn't just some little accounting quirk that you can ignore. It's a real, growing challenge for anyone who manages property. As technology, regulations, and even our climate keep changing, this gap between the physical world and the financial world, it could get even wider.
So why does this gap matter so much? Well, this slide lays it out perfectly. If you don't account for this gap, your cash flow plans are going to be wrong. Your budgets for big replacements will be totally unrealistic. Your ROI calculations skewed, and you won't be able to really maximize your tax strategy. It literally touches every single financial part of owning property.
And things are getting even more complex. That same DNV study shows that new, better technologies, like these commercial heat pumps, are now lasting longer than we used to think, a proposed physical life of 20 years, up from 15. So the physical world is evolving, which is great news, but
It leaves us with this massive, critical question for the future. As our equipment gets smarter, more efficient, and more durable, are the financial rules we use to account for them actually keeping up? Or is this gap between an asset's 2 lives only going to get wider? That's something every single owner and investor is going to need to watch very, very closely.